If you've been watching the markets lately, you've definitely seen the headlines about Prologis. This is a $133 billion real estate giant, and today we're doing a full explainer on exactly how they drove a massive 29% stock surge over the last year. And spoiler alert, it's not just about traditional warehouses anymore. We're talking about an aggressive, massive pivot into digital infrastructure. So here's our roadmap for today. First, we'll look at their $19 billion mega deal, then their record-breaking financial growth, followed by that huge data center pivot. After that, we'll check out their strategic partnerships, Wall Street's bullish verdict, and finally, we'll weigh the actual investment risks. Let's just jump right in. Section 1. The $19 billion mega deal acquiring Segro PLC. Okay, so on August 4th, 2026, Prologis drops a bombshell. They announced they're acquiring their British rival Segro plc for an astonishing $19.19 billion. The backstory here is actually pretty fascinating, right? This wasn't just a quick, friendly handshake. Segro actually rejected 3 previous takeover attempts. They were playing hard to get. It wasn't until some of their major shareholders, specifically APG Asset Management and Norges Bank, really turned up the heat that Segro's board finally agreed to sit down at the negotiating table. Now, nearly $20 billion is a massive price tag, but Prologis CEO Dan Leder didn't mince words. He outright called Segro's portfolio irreplaceable, and he's got a point. By acquiring Segro, they aren't just buying up some buildings, they're buying an undisputed global leadership position, locking down a massive footprint across the UK and continental Europe. This whole thing paves the way for a combined global entity with a market cap of over $152 billion. So how exactly is a deal this huge actually getting done? Well, Segro shareholders are getting a mix of shares and cash. Specifically, they get 0.0920 Prologis shares for every Segro share, plus a partial cash alternative. To help foot this massive bill, Prologis priced a massive public stock offering that's expected to pull in $2.1 billion. Pending all the usual regulatory green lights, the whole shebang should close in the first half of 2027. Moving on to Section 2, record-breaking financial growth in their Q2 2026 earnings. Now, real quick, before we dive into the raw numbers, we need to talk about core FFO, or core funds from operations. If you're looking at a real estate investment trust, or a REIT, this is literally the most critical metric you can use. It shows you the actual fundamental cash flow generated from standard day-to-day operations, completely stripping out any one-time property sales. And honestly, by every single metric, Prologis absolutely crushed it in Q2. Net earnings surged a mind-blowing 85% year over year. They jumped from 61 cents a share back in Q2 of 2025 all the way up to $1.13 in Q2 of 2026. On top of that, they beat core FFO estimates, landing at $1.63 per share, with total revenue topping out at an impressive $2.18 billion. To really wrap your head around their immense physical scale right now, just look at their leasing activity. They signed a record 67 million square feet of leases in a single quarter. To put that into perspective, that's enough space to cover over 1,100 American football fields. And they rented all of that out in just 3 months. This crazy demand pushed their period-end total occupancy to a super healthy 95.5%. Because they are just firing on all cylinders right now, management went ahead and confidently raised their full-year guidance for the second time in 2026. Notice those massive jumps there? They significantly boosted both their core FFO and net earnings projections. They are basically signaling to the market that they have absolute confidence in their continued operational dominance for the rest of the year. Which brings us to Section 3, the data center pivot, a totally new growth engine. This right here is the real reason investors are so incredibly hyped. Historically, Prologis was your classic e-commerce logistics play, right? Warehouses, distribution hubs, that sort of thing. But AI and cloud computing require specialized land with huge amounts of electricity, fiber connectivity, and water. Well, Prologis just happens to sit on a 14,000-acre land bank with an embedded development opportunity of 240 million square feet. So they're taking this massive real estate advantage and building out the essential digital infrastructure for the AI revolution. It's brilliant. And in the AI world, power is everything. By Q2, Prologis rapidly expanded its data center power pipeline to a staggering 5.8 gigawatts, which is up from 5.6 just a quarter before. And here is the kicker for domestic investors. About 86% of that massive power capacity is secured right here in the United States. They aren't just talking a big game either. They're putting serious cash behind this. Prologis committed $4 billion to data center developments in 2026 alone. This even includes an absolute monster of a project, an $800 million, 260-megawatt build-to-suit facility that they actually intend to just sell off once it's finished. Management has made it crystal clear that this is a prolonged growth opportunity, driven entirely by AI. It's fundamentally changing how the market values them. They're not just a real estate company anymore. They are a digital infrastructure powerhouse. Section 4. Strategic backing and partnerships. Expanding the footprint. Now, usually, expanding this aggressively means taking on a massive mountain of debt. But Prologis has a totally different playbook here. To grow without trashing their balance sheet, they're partnering with absolute heavyweights. In the US, they teamed up with GIC, Singapore's sovereign wealth fund, for a $1.6 billion joint venture. And over in Europe, they set up a €1 billion or $1.2 billion venture with Canada's CDPQ. This is just a brilliantly capital-light strategy. It lets them leverage third-party money to capture massive global growth while keeping their own capital requirements super low. And institutional investors? They are eating this up. In the second quarter alone, major players like Westpac Banking Corp and Landscape Capital Management opened brand new multi-million-dollar positions. Plus, heavy hitters like Barclays, Citadel, and Wells Fargo have all disclosed active positions. Having this kind of broad institutional backing is a massive vote of confidence in Prologis' dual strategy of logistics and digital infrastructure.
Section 5. Wall Street's bullish verdict and analyst expectations.
So right after that August 4th Segro announcement, analysts went into overdrive with a rapid-fire sequence of upgrades. RBC Capital bumped the stock up to outperform with a $160 target. The very next day, BMO Capital maintained their buy rating with a $163 target. And the day after that, Jefferies kept their buy rating but raised its target up to $168. When we step back and look at the broader consensus, the picture is pretty clear. With the stock trading around $141.80 in late August, the average target across 17 polled analysts implies roughly a 12% upside. So across the street, you're looking at a very solid, broad buy consensus.
Section 6. Weighing the investment risks and harsh market realities.
As with any major transition, this isn't without peril, and we need to keep this explainer perfectly balanced. Investors have to weigh some pretty heavy anchors here. First off, they are carrying a staggering $37 billion in total debt. Second, integrating a $19 billion behemoth like Segro comes with massive execution and regulatory risks. Third, there are analysts projecting that total revenue could actually drop by about 5% to $8.74 billion in 2026 compared to 2025. And finally, their valuation is sky high right now, currently trading at a PE ratio of about 31. And if we dig just a little deeper into that valuation, things look even more stretched. Their PEG ratio, which measures a stock's price relative to its expected earnings growth, currently sits near an astronomical 130. What that tells us is that the market has already heavily priced in all these massive growth expectations stemming from their AI and data center pivot. Basically, a lot of things have to go exactly right to justify paying that kind of premium.
Prologis clearly sits right at the fascinating intersection of two massive secular trends, the enduring need for e-commerce logistics and this explosive AI data center boom. They've got the land, they've got the power pipeline, and they've got the capital backing. But with so much future growth already baked into the stock price and the headache of integrating a $19 billion acquisition on the horizon, you really have to ask yourself, is this the ultimate AI real estate play, or has the market maybe gotten just a little ahead of itself? Thanks so much for joining me for this explainer, and I will see you next time.